Good morning. Welcome to Retirement Unlimited, the show where we discuss life's hard financial questions to help you make smart decisions with your money.
I'm Randy Barkley, and I'm a certified financial planner, and I'm here with Jeremiah Lee, who is also a certified financial planner, as well as a licensed attorney. And he helps our clients make those we come alongside our clients to help them make the good financial choices about their life.
This week, we are talking about looking back and looking forward, trying to predict where we're going to be, trying to predict where we've come from. I mean, Randy, has this year gone the way that we thought it would?
No, in fact, a lot of reports we look at, their predictions going back to the end of 2021 and the start of 2022, and a lot of people were predicting what the economy, and then we've gone back and looked at various years. I like to keep magazines and reports going back several years and look at the January and the June to see what people are predicting. I think probably the most certain prediction for 2022 has been rising interest rates. And rising interest rates have had an impact upon bonds more adversely than on just about anything else. And I think most people were expecting that. I guess the question is the rate of rise in the interest rates, right?
Yeah, but I think to kind of get the context for everybody, right now we're at a spot. We're middle of June, near the end of June, and kind of trying to decide what do we do next. And everyone in the market is saying, are we going to have a recession? Are we going to have, we're going to go up from here? And our idea today is to look back at what everyone thought in the beginning of the year. And were they right? Were they wrong? I mean, the fear you hear on the news, do you need to believe it? Do you need to ignore it? And so January 3rd, if everyone would remember, was a high point in the market. A lot of the Dow, the S&P, they were setting records, brand new records that we'd never had before. And from there, basically, it just turned and went straight down. We've had from January till
well, again, the market, and just to kind of respond to that, I see we got two markets. I see we have two markets going on, a third if you consider the bond market. But I think the value-based stocks versus the high dividend payers and those classifications versus the growth stocks, the big six I call them, that made up a majority of, or made up a big percentage of the S&P 500 going back to that December date. But we've seen really two different markets going forward.
Yeah, that's a really good comment to distinguish, because amidst of 2, 3, I mean, the more we slice this up, the more differences we see. But the talking heads, at that time, when you had January,
talking heads for sure.
People were talking about inflation. They're concerned about things coming down, things being overpriced, and the markets, come down. But you're right, in different segments doing different things. And now the talking heads are talking all about recession, gas prices, food prices. Where are we going to go from here? I just wanted to, highlight a few items that have happened, and the fears we've had over the last even 2 years of kind of how difficult it is for these people to project and for us to project. So from January 2020, so before COVID, before the big drop.
Just before COVID, right?
Just before COVID, it's on the end of the year, to June 2022, so this month, basically the market is 14% up. So in the midst of that time, it's gone massively down, it's gone massively up. But in the midst of all that, we had a big drop quickly, and then we had a recovery. It turned like a V, and it kept going up. But in the midst of that, there's been fears of Omicron variant, Delta variant. There's been discussions of the Great Resignation. Are we ever going to recover from this?
Right.
Stimulus payments, corporate liability. I mean, I remember fairly early on there was concerns when people wanted to come back to the offices to say our corporation is going to be liable if people get COVID. Russia invasion, of course, that's more recent. Inflation, people being unable to hire. Racial tension. I mean, all that has happened in the course of this last 2 years. And I think it's interesting, people as of January 2020, what they're predicting, they didn't predict any of that. They had no idea. And, COVID's a unique moment. But then as we got to January 2022, all the things that they're projecting, it's really difficult for them to do. They're looking at, we have all new prices, we have this great idea.
And you've got people with, again, the talking heads on television. I always tell my clients, be careful who you listen to, because they reinforce your biases, particularly social media and such as that. So a lot of the talking heads are reinforcing this recession thing because bad news sells, right? People want to hear and they want to see the train wreck. They just don't want to be part of the train wreck. And I think what's happening is the more and more that we talk about recession, we're seeing, for example, interest rates, mortgage rates went from 3% to almost 6%. And really no reason for that other than the fact that the market changed amidst all this conversation about a recession. And so that's starting to have an impact upon real estate. And again, we've talked about in previous programs that there's two sticky parts to the inflationary side. It's the real estate side and the oil side, the energy side. And we're starting to see real estate, the capping of it, I guess is the best way. And the mortgage rates, of course, are having an impact on that. And now the oil prices, again, the economy is still booming from the standpoint of lower unemployment and that, but I think people are starting to see that impact of higher gas prices, and it's starting to affect their spending. And we're also starting to see we're hearing about certain retailers, large retailers, that they got excess supply. In other words, they've got a lot of inventory that's building up that they did not expect to have at this point in time. That could be recessionary.
Yeah, no, those are really good comments. And I think we talked about last week that a recession is a psychological event.
Right.
It's not just an economic event, because the idea with the Fed raising interest rates is they want to bring down people's consumption. They want to bring down the speed at which we are traveling. They want to, stop people from going to the beach or the mountains. Spend less. Save a little more.
Right.
And the hard part of this soft landing that we talked about last week is if the Fed can increase the interest rate and not at the right pace, that everything slows down together, that's great. The hard part is, I think realistically in life, nobody slows down until they just say this is too much, and then everyone cancels vacations and stops driving.
Again, if you're a job, of course, we live in Southern California, and of course, our economy is, how we adapt to it. But I think of the people when I occasionally get on the freeway and I see the number of cars on the freeway. And I think about the people that have to work, 30, 40, 50 miles away from their home, and they're not able to work remotely. And they have to pack up and get on the freeways. And gasoline prices are real. So if you have a truck and that's part of your business, that is really hitting your bottom line. And you come back with less income. We've talked about it in our offices, how can we help our employees with some of the gas prices? And it's not easy to do that, because if you give an employee more money, there's some companies that are doing this, well, the taxes are going to be taken out of that. So the employee is not going to get a direct benefit of that, 100 cents on the dollar. They're going to get more like 60 or 70 cents on the dollar. And that makes it harder for companies. So again, I think the sharing pain across the spectrum is real. And I think that earnings will come down, don't you think?
Mm-hmm. I think you're right. I think corporations are trying to find their way through just like anybody else.
Right.
And some corporations are going to do nothing. Like you said, we've read about some they're giving nice stimulus and things to employees to kind of get through this season. And the question is, how long will the season last? Are we talking about a year here? Are we talking about multiple years? One item of a recession that we talk about in our office is how long. And part of the difficulty that people have in projecting these things is, even if we do go into recession, when they call it a correction, meaning it went less than 20% down, often there's some averages, but say in 7 months or so, 7 to 9 months, you often have recovered from that. It kills the better part of a year, but you've recovered. And these bear markets, where it actually goes below that 20% line, often, I think the average we were looking at was around 15 months for it to recover. And so with this moment, we've I think formally...
And that's to recover from the trough. So you can see a recovery, but to get back to where you started, So we're going back to that December date that you had mentioned earlier. That's when the market was at the peak. So if it goes down, the market could recover, but it may not get back to that December date for 15 months or 17 months or something like that. But you see a recovery coming on.
No, that's a good clarifying of getting back to where we started. Before we went down, how do we get back to that same peak? And for this, if we're going into this recession and it has inflation, it has high fuel prices, high food prices, if people need to get through this for 2 or 3 months, that's very different analysis than if this is going to be, say, 24 months before we kind of recover to where we were. And I think for people, as they're getting to look at their portfolios, you are significantly rewarded by staying invested. There's a chart we talked about a few weeks ago, but it kind of had from the 1980s till now, and it took out just the 10 best days of the market. So if you just missed these 10 days, whatever days they were, whether they came at the bottom or came at the top, your portfolio was about half of what it would have been had you stayed in the market the whole time. And the hardest part we have on those is those best days, come sporadically throughout.
Yeah, and I mean, I think just in a more current illustration, 2 weeks ago, the market corrected, and we saw a sell-off, and it ended the week with somewhere around 4 to 5%, depending upon what the holdings are. And as I talked to clients, there were some clients saying it's just going to continue to go down, will it? And I said, no. But I said, if you pull out, I said, you could miss an upside, like what you're referring to. But the following week, last week, that's exactly what happened. The market corrected up, and it corrected up gangbusters. Now, had you been out of the market, had you sold, in other words, if the emotions had driven your actions, and you had sold the week before, you would have missed the upside.
Yep.
And what you're talking about is that if you don't stay invested, and if your allocations are, you do your alignments earlier, but you miss the upside, and you miss, and that has a dramatic impact upon your overall return over time, doesn't it?
It does, yeah. And to know what we're talking about as far as the long run, I mean, if you're going to be invested, say, for 2 to 3 years, then the idea of selling, in most instances, is just trying to time the market. Right. Just trying to get it right, to get out, to get in, and you're going to miss a lot of the interesting items. So, I mean, even go back to that earliest example, January 2020, pre-COVID, till June 2022, you're up 14%. And if someone was able to put the blinders on and say, I want to be invested, that's a great spot to be in. It's not the most incredible returns, but it's decent returns between then and now. And if someone was really timing it and getting it all right, they exited at the right point, they missed the fall, they bought again, they'd be, phenomenal. But that takes a lot of time, especially to do over time, to get that consistently right. And so, some investors, let's say they're day traders, but they're trying to time that market, and they're going to miss some, and how much of an impact that miss will have is really meaningful.
Yeah, I mean, I think, again, we go back to economic analysis. We spend a great deal of time trying to understand what the macroeconomics are, and we rebalance. Now, so back in December and January, it was an ideal time to harvest. We took some money off the table, we rebalanced those into value-based stocks, and we put more into cash. We kind of built that out. We shortened the duration of our bonds. We were trying to get a less risk in the bond market, knowing that we were probably going to see higher interest rates. But our emphasis was towards equities that were paying dividends. And looking back at it, there was a huge separation between the growth assets and the value-based assets. Now they're all down, but if you look at proportionally what the value-based assets are in relationship to growth, there's a big difference. And for the people that are listening to us, if you need to get an understanding, and we can help you through that, and to be able to identify value-based assets versus growth assets, and historically what their return has been over this period of time. I mean, and this is a picture in time right now.
Yeah, and we're not done with the recession. We always tell people, not to make fear-based choices at the bottom, or fear-based choices really ever. But there's a moment to retool and to say, am I holding what's best for the projected, the possible, the potential future going forward? And yeah, if people are still in growth stocks, everyone we're listening to economics, for the economists, it's not a rosy picture. They might do well, but they don't see it taken off, whereas value stocks seem to have a really strong future still ahead of them.
And if this resonates with you and you'd like to know more information about this and how this work, how these decisions would really help secure your life financially, reach out to us and give us a call. Our phone number is 951-684-7011, or just simply go to our website, which is www.retirementunlimited.com.
If you have a topic you'd like us to discuss on a future episode, you can call our office, leave us a message, or even in the comments below, you can leave a topic and we'll talk about that in a future episode.
Until next week, folks, may you grow in wisdom and knowledge. Thank you for listening.